All right, guys, if you're struggling with understanding how trading works from a true mathematical perspective and you want that confidence to actually day trade the right way and become profitable quick, this is it. So, this is not your usual trading video, as you can see, right? We're not looking at charts. I mean, we will, but you can see right here, like, we're not, the way I take trading is I take it from an intellectual mathematical perspective because by nature, this is an intellectual field, right? You have hedge funds, you have quant funds, you have people who take this shit seriously, who get PhDs, who create all these advanced algorithms, and just it's such a mathematical dense field, and that's why we're gonna cover the math because the issue is that retail traders, okay, they don't understand what it means to be a profitable day trader and how the math behind it works. And if you can understand the math behind how day trading works, you're going to 100% set yourself up for, understanding and just becoming way better off for your setups, for your executions, etc. once you understand how this works. So basically, we're going to be covering the secrets, which is what I think is the secret to profitable day trading, which is this. So you're probably looking at this and you're like, okay, like what is going on here, right? What am I looking at? So what you're looking at right now is the proportion of heads over 200 coin tosses. So on the x-axis here, we have the number of coin tosses, and then on the y-axis, we have the percentage of heads. And the whole point that I'm going with this is to show you of how the math behind trading works when you take trades, when you're winning, when you're losing, when you're going through the whole motions of taking just day trades and just, you're trying to pass your profit room challenge and just how it works mathematically. Let's just start with like a little thought experiment. Were to say, hey, this is my backtesting sheet. We're gonna use the backtesting sheet to kind of convey this. But if I were to kind of, I get the question all the time. What's your win rate? What's your risk to reward? What's this? What's that? And that's gonna be for a bit later. But like, there's a reason why. After you watch this video, you're going to understand why I cannot answer those things when people just ask me like off rip, like, oh, what's your win rate? What's this? What's that? And why I can't answer some questions when a lot of you guys maybe ask like, oh, what's your strategy? This and that, because it's much more nuanced and much more complex than you think. And it's a lot of effort for me to convey that just off one random TikTok comment or something. You guys all know coins. You guys know what a coin is, right? You guys obviously have flipped coins before, right? Heads and tails, and trading is the same exact thing. I want to ask you guys a question, and so I know you watched the video. Comment the answer down below of what the answer to this question is, and this thought experiment, and I'll heart it and I'll respond to you guys because I got to make sure you guys are participating, right? We're gonna flip a coin 10 times, all right? And what I want you to do is, once we get to the end of this, I'm gonna make you sit here. You're gonna have to watch this whole thing. I want you to tell me what the probability of getting heads and tails is after we flip this coin 10 times. So as you can see here, the way we're going to describe this is we're just going to ignore risking RR. We're just going to, obviously, in terms of day trading, we're going to assume heads is a win and tails is a loss, all right, for simplicity purposes, all right? Okay, so we're going to flip 10 coins in a row, and we're going to see how many heads we get. What's our percentage of heads? So let's start. All right, we're going to flip it. We got heads. All right, we got heads again. Oh, wow, heads a third time. We're on a win streak, guys. Ooh, heads for the fourth time. Okay, we got tails. We got heads again. Okay, we got tails. Heads again. And heads again. Okay, based on this, right? Actually, we gotta do one more. So one more. Heads again. Okay, so out of 10 flips, we clearly see we have 8 winners, which is 8 heads, and 2 losers, which is 2 tails. So just off this, I want you guys to answer this question. What is our probability of getting heads? Based on this data, based on what I just showed you, we flipped it 10 times. Well, it's showing us that we had a 80% chance that we get heads, right? So clearly, we now know that our probability of getting heads is 80%, right, guys? Absolutely wrong. This concept is called the law of large numbers, okay? And the law of large numbers states that as you increase your sample size of a probability space of an event, you then get closer and closer and closer to the true probability of what is going on. You can't just take 10 flips and if 8 of them are heads, say that, oh, I have an 80% chance now or an 80% win rate, because that's just not true. And you don't even realize it because your data is such a small sample that it skews your whole characteristics. It skews the whole mathematical component of what's going on. This is the same exact thing that happens in trading, but I'm going to show you a visual example of what we just did here and kind of show you how this looks visually. So we're just looking at the probability probability of getting heads on this chart right now, and you're going to see as I increase the number of samples, it's starting to do some type of, convergence. It's converting to this line right here, and this line is 50%, right? Because we know that a coin only has two event spaces, a heads and a tail. So obviously there's an equal chance for, heads and tails, right? 50-50. But when you're actually doing the flips and you're actually doing the repetitions, it doesn't look like it's 50-50. So as we keep increasing, so you can see we're converging to a certain line. And this is the exact point that I'm trying to stress to you guys. You might think you're profitable. You might think your style of trading, your system, your whatever, your mechanical system is working. But in reality, it actually might not. Because what day traders like to do is they like to assume and they like to associate something that happens a couple times is, oh, now this is like a truth. This is going to happen 100% of the time. And, now I know what the market's going to do. And that's just not the case. So you're probably wondering like, okay, if I'm just telling you like, oh, mathematically day traders are failing and, it doesn't make sense. Like, where am I going with this? Like, what's the whole point of this video? The point is you have to create an edge that over the long period will converge to a certain statistic. The edge from day traders and the edge from trading comes from repeatability. It's something that is repeatable, that is valid based on an enormous number of samples that can be mechanically done every single time, X, Y, and Z. What do I mean by repeatability? I mean, when I say repeatability, what I'm trying to say is no matter what happens, you are doing the same exact thing every single time, okay? So why are institutions so powerful? Why are quant developers, quantitative trading so powerful? Is because they are able to code these events, these systems, right? These stepwise systems into their models and back test them. Basically they're able to simulate different steps over hundreds of thousands of trades, because just because something looks like it's working now does not mean it's going to work a week from now, a month from now, etc. For example, a simple system could be every time this 15-200 moving average crosses bullish, then you want to buy, and every time it crosses bearish, you want to sell. And if you're in the position, you just want to reverse it, right? Close your position and reverse. So obviously, every single signal you can see right here is a buy and sell, right? We buy here, we sell here, we buy here, we sell here, and then we don't cross until here, we buy here, we sell here. But how much of an edge does that actually have? Over 10,000 trades, does that give us something? Does that give us profitability? Does that give us an edge of where we actually make money? But here is the caveat. You guys are just, some low-level retail traders. No, I'm kidding. But you guys are not quants. You guys are not institutions. You don't have hundreds of thousands of dollars, not dollars, but samples, data sets, billions of dollars like these institutions do that are actually trying to crack this code and build profitable models that can make a lot of money. And now here's where I come in and tell you hope is not lost, because as a retail trader, you can be profitable. This is how I'm profitable. This is how every single other day trader is profitable. You just have to understand the secret, which is this. Your edge as a retail trader comes from discretion, risk management, experience, and a playbook. A playbook based on high probability concepts, based on all these things that after doing, maybe 100 times, 200 times, that you will, potentially have an edge with this. And now you're probably thinking, oh, this is completely counterintuitive to what I've been preaching this whole, video, right? But this is the only way you can become a profitable day trader as a retail person. Like, sure, you can develop algorithms, you can develop a mechanical based system, but a lot of you guys just don't have the infrastructure and the ability to do that. The edge from retail day trading comes from these four things: discretion, risk management, experience, and a playbook. And now I want to take it a step back. Actually, when I mean repeatability and have an XYZ system that does this every single time, the issue with a system that is fully mechanical and repeatable is that no matter what you do, okay, every single system that is mechanical, it will have drawdown streaks. It's not a if and or, it will 100% have losing periods, because a fully mechanical system cannot account for every single thing in the market. You're only accounting based on your steps, which is going to happen a certain number of times in the market. For example, if you have a trend following systems do terrible in mean reverting, conditions, right? Consolidating conditions, and vice versa. Consolidating trading styles and trading systems just do terribly in trend following systems, because the steps and the nature of a trend following system is completely opposite for a consolidation based mean reverting system. I want you to take a look at this right here. Okay, I'm going to show you one of my mechanical systems, its equity curve. Do you notice something right here? This is an equity curve of a real trading system that is fully mechanical with maybe 5% discretion. Do you see how it has these big losing streaks? This is inevitable. Every trading system and every equity curve is going to have something like this. If you ask somebody to show you data on a trading system that's mechanical or whatever, and it does not look something like this, tell them they're a fraud, because they're fooling you. Okay. Now, obviously in this case, this is based on a certain type of win rate in RR. This is a lower win rate, high RR system. It's going to obviously look different if you have a high RR, low RR, high win rate system. Is going to be different, but the principle is still going to be the same. Each system has its pros and cons. Each style has its own pros and cons. But the main underlying thing that I'm trying to point out is there's no system that can perfectly predict the market. Okay, and because of this, you are going to have inevitable drawdown streaks, which now we get into prop firms, right? You trade prop firms, and there's a reason why people fail, and there's a reason why this whole trading industry is cooked, and you guys don't understand how it really works, because prop firms are not designed for real trading. A prop firm account, Top Step Futures, CFDs, they give you anywhere from 3 to 10% drawdown of your initial account size. I want you to take a look at this equity curve right here for this system. This system is clearly profitable. It is 100% profitable. You can see it made a 7,000% net gain over these amount of trades. But notice these dips in the equity, these drawdown periods, okay, that are inevitable. If I were to start a prop firm challenge in one of these points, in one of these drawdown points, obviously we don't know what's going to happen in the future yet, but we do know that this was destined to happen. Well, I'm destined to lose, right? It's not that I'm applying the system, incorrectly, or I'm doing something differently, but that is how real trading works and a mechanical system works and real math works. I can lose, let's say this is just hypothetically, let's just say this is, 10 trades, right? I could lose these 10 trades, but in terms of the prop firms, the prop accounts, I've just blown my prop account. But then notice on the 10th trade, I ended up making what, like 1,000% gain, 2,000% gain from here to here. But it doesn't matter because I would have already blown my account. There's nothing I can do about it. And that's what I'm trying to tell you guys, okay? Prop trading, there's a very specific style of prop trading that only works. It's high win rates, lower RR systems, 1-to-1s, 1-to-2s, or even negative RR systems, or completely discretionary trading, which is what I do, which is what everybody does, and that is where the edge from prop trading comes. The issue is becoming a good high-level discretionary trader takes about 5 to 7 years, okay? This is not easy. I'm on year 4. I'm pretty good, I'd say, but I'm nowhere near my potential, and all of these things are a factor, right? Like understanding, the discretion, right? Understanding risk management, getting the experience, and obviously developing your playbook. I can't tell you your playbook, right? I understand the concepts that I, use and the way I trade. I'm not going to give that out. You have to figure that out for yourself. But then also combining that with the risk management, like what I just said, right? My point is you guys have to tackle this from a high level perspective and get your head out of the gutter, get your head out of your ass. You need to continually refine, okay? Collect data, get market experience, and be on the chart 10 to 12 hours a day if you want to be profitable as a retail trader, especially for trading prop firms. Now, obviously, you could probably employ whatever algorithmic mechanical system that you have on a personal account. This is why I also have a personal. But I'm trying to show you the reality of what's going on. Okay, let me give you an example, right? A very, very big, popular strategy and popular style of trading is liquidity sweep. So you see right here, we have a liquidity sweep, and then we wait for some type of break of structure. Okay, I want you to do the same exact thing based on your rules 1,000 times and tell me, does this playbook actually work? And the answer is actually going to be kind of sad for you guys, because no, it doesn't. The way you become profitable off taking whatever trade playbook is you get an understanding of the data behind what is going on after you've collected a sample set of data, and understanding how you can take advantage of this based on how the market moves. I'm not going to, expose the sauce. You have to figure it out, but I just gave it to you. If you are able to discretionarily pick and choose, okay, I'm taking this setup based on this, this, and this, or I'm not taking it based off this, and this, okay? That is how you get your edge, but a mix of the two, using mechanical concepts and discretionary analysis. But I hope this video made sense, guys. I don't want it to be too long, but I really want to drop some gems and drop some banger sauce for you guys, because I really want to pound in how the math works. Again, make sure you drop that comment, and if you have any questions, my DMs are always open. But guys, I'm telling you, what's my whole point with this, okay? You have to continually get chart time and do these things. Understand high probability concepts, risk management, management, having a daily loss limit, 1 to 2 trades a day, etc., and then your discretion based on a pair. There's a reason why I only trade gold, guys, because I don't know how any other pairs work, right? I only trade gold. I'm a master of commodities. I'm a master of gold, right? I know gold in and out. And that's exactly why I mean discretion. You can't get discretion on 30 billion pairs, right? Especially if you're trading on the lower time frame. It's just not possible. But you can get discretion on something like one pair. Master of, jack of all trades, master of none. Don't be cynical. Just understand how this works. When you are trading a prop firm, when you are trading in general, this is what you are doing. Anyways, I love y'all. See you in the next video. Hope you enjoyed. Peace.